Hey everyone, welcome to our CalCaf webinar. Thanks for joining us. My name is Mary Kurzweil. I'm an analyst here at CattleFax, and yeah, with that, we'll get going here. So what we're going to do is we're going to start with the corn and hay situation, and then we'll get into the cattle cycle and supply outlook. Then I'll talk a little bit through the economy and demand expectations that we have going forward, and then my colleague Holden Ramey will take over, and he'll give you a 2025 cattle market outlook, and then also go into depth more on the calf and female market discussion. So that's kind of what we're looking at today. So to kick us off, looking at the corn, you can see that here for the last few months, or what this is showing here is this is the price is this red line, and then the stocks to use is these bar charts. So what we've seen the last couple of years is we got into a more comfortable stocks to use position, so up in that 14 to 15% range. But here over the last several months, we've moved quite a bit lower here. So the last couple of reports, we've seen increased demand, and then we saw a pretty big decline to the yield for this last crop year, so the 2024-2025 crop year. And so that moved stocks to use quite a bit lower. So we went from 14% to about 10% here. Now, if we look back historically, that's still above those levels that we saw back in 21, 22, and relatively a comfortable position. But it makes sense that with this move to stocks to use, we've seen the corn market rally here in the last few months. But what that's done is it's from our expectation, it's bought some more acres for corn as we do look at this next crop year. So looking at the 2025-2026 crop year, we do expect to get back up to a more comfortable stocks to use percent here, up near 13 to 14%. That's with more acres, and then yield a little bit better expected for this next crop year. But here short term, we might see some higher prices. But then if we think about 2025 as a total, we should get into more supply as we think about the second half. And so on average, we're probably going to average higher for this year. And as we look at this upper end of the range, up around $5 a bushel, that's probably going to take place here in the first half as we have tightened up those stocks to use levels. But as we think moving forward, we should be buying back some acres for corn and get into larger and more comfortable supplies as we think through the second half, where we might see more downward potential for the corn. Looking at the hay market, we've seen this moderate quite a bit here in the last couple of years. So we saw up in 2022 especially, saw weak production or small production levels, and we had a tight stocks level for hay. And so we saw prices get pretty elevated there. Here in the last couple of years, we have increased our production and gotten to a more comfortable stock level, although not as large as it has been. We do expect more moderate prices for the hay, so more around this $175 to $180 a ton as we think through 2024 and then 2025. So as we look historically, you do tend to see this hay follow the corn, or they move together pretty closely. But there have been times where hay can stay elevated for a little bit longer, as the seasons are a little bit different there, and it can take some time to get the stocks built back up. But here where we do see the spike in the corn, that's been more of a demand-driven spike, and then a lack of supply whenever we consider yield being smaller. So we haven't seen the same changes to the hay reports, and ought to see more steady prices for the hay as we do look ahead. So switching gears here a little bit, we're going to get into the cattle supply situation. We like to start with this general chart, so just looking at the typical cyclical pattern for the cattle cycles. So as we look, we're kind of here in this we would say we're here in this first section still, where we are working on rebuilding. So we ought to be about through the liquidation period and should start to rebuild the herd here as we go on forward. But yeah, you can see that the pattern does take several years, and it typically goes for 10 to 12 years for this full cycle. We'll get into more of the specifics of this cycle in particular as we go ahead. Before we get into that, I like to use this chart kind of as a sustainability chart, so you can see that here we are, we do have fewer cattle over time. This has just been a downward trend. We do tend to see lower lows for the cow inventory through each cycle, and then also lower highs as we do move through it. But at the same time, beef production has held pretty strong throughout these declines. And so how that's happening, that's larger weights, of course, improved animal husbandry, and then utilization of the dairy industry. So between those factors, we have been able to keep strong production for the beef side and help to meet that consumer demand. As you can see, we are going to get deeper, or we have already gotten deeper here with the smallest cattle inventories through this liquidation phase. But beef production is not expected to get as low as what we saw back in the 2014 cycle. So even with the declines, we should keep it more relatively elevated with the larger weights and then the rest of the factors. So there's been a lot of speculation on this, this rebuilding, because as we think about it, there's a lot of headwinds to expand. But what's going to drive this expansion is cash plus grass. So we have seen higher prices, of course, but then the grass part is more of a headwind as we are back into a La Nina weather pattern. And then there's also the other factors such as high interest rates. Those have come down some, but they're still relatively elevated. The labor and or aging producer, that's talked about a lot within the industry, and it's definitely a concern. And then the market volatility and just uncertainty that we've got along with those high interest rates. And then we've got the sharp memory of the 2015, 2016 decline that we saw to the cattle market as we did get into sharply larger supplies and then lack of packing capacity. But as we think ahead, we do have this cash part of the equation there with the higher prices that we've seen. The grass part is a little bit more mixed here. So if we look at the drought monitor map, you can see that we're in a little bit worse of a situation here compared to year ago levels. Through the winter here, we have been back to the La Nina weather pattern. If we think back a year ago, we were transitioning it to the El Nino weather pattern, which is typically wetter. But yeah, we're back into this La Nina weather pattern, and you can see drought's been pretty extreme here in the southwest U.S., West Texas especially, Arizona, California, and then also the northern plains have been extremely dry here lately. And as we look on ahead, we're likely going to stay in this La Nina weather pattern as we look through the end of the winter. And then we might start to see more of a neutral pattern as we do get into the spring and the summer there. At least that's what the probabilities are showing today. So we know that La Nina is typically drier for the U.S. El Nino is typically wetter. So the neutral pattern, what does that mean? Does that mean it's kind of in the middle? Well, what Matt Makins has shown with these charts, these are all precipitation charts for October through March. So we're halfway through this period of time. You can see that we have followed this La Nina weather pattern pretty closely with where we saw the drought. And so we are here in this more weak La Nina pattern. If we were in a strong one, you would see this drought be even more extreme throughout this time. But we are still in this drier pattern here. But as we do move into a neutral pattern, you can see that it's still pretty dry. The drought levels aren't as dark, so not as extreme, but still relatively dry through this southern plains especially, and then the northern plains as well. So even as we do move into the neutral into the spring, it doesn't mean a lot of moisture, but it does, it should mean a little bit less of the widespread drought and maybe a little bit of easing from that. So with all that, like I said, the grass is going to be more mixed throughout the U.S. and a little bit more questionable. So So as we look at the expansion this time around, we do expect it to be more of a U bottom or a slower growth to the herd. So we do expect that this January inventory report will have the beef cow lows here as we start 2025, just down 200,000 from year ago levels before we can start to see an increase in 2026. If we look back at this last cycle, you can see that the low came in 2014. They added some back by 2015, but then they had about a million head increase from 15 to 16. So there was sharply more cattle available when that occurred. So this year, we don't expect to see that kind of increase. We do expect to add some in 2025, but it's going to be a lot slower growth because of those headwinds that we talk about with the higher interest rates, drier weather pattern, and then aging producers and whatever other headwinds that we see there. So just a slower rebuild to the cow herd, and likely won't get back up to those levels that we saw in 2019. All right, so yes, the slower growth to the herd is what we'll expect as we move on forward here. Part of the reason that we won't see an increase to the cow herd, or we don't expect to, as we look at this January report, is that we didn't have enough beef replacement heifers as we think back to the beginning of 2024. So even if producers did keep back some heifers here in the fall of 24, they'll go into this report as replacement heifers, and then they'll have their cow this year, and then they'll count as cows in the 2026 inventory report. So it will take some time to build up that cow inventory number. Part of that being because we don't have a lot of replacement heifers, or we didn't as we started 2024. We do expect to see a few more as we look at 25, and then continue to see that growth in 26. The other portion of the cow inventories that we like to look at is the dairy cow inventory. So one thing to note with this chart is compared to the beef cow inventory when we were looking at 30 or 28 to 31 million head, this herd is pretty range bound here between this 9 and 9.3 or 9.4 million head. So when you see these big moves on this chart, it's really maybe 100,000 head rather than a million or so that we saw with the beef cow chart. So that's important to note here. But as we look, this has been a pretty stable inventory. We did see some declines in 2021. There was pretty poor margins for milk at that time, but margins have improved a ton for the dairy cow producer. What's really limiting the growth here near term is that there's been a shortage of replacement heifers for the dairy herd as well. Part of that being due to the increase in beef on dairy that we're seeing. So long term, we do expect to see some growth, but yeah, short term, it's going to be a little bit more limited because of the lack of replacement heifers that we've got for the dairy herd. As we look at the inventory that comes from, or the beef inventory that comes from the dairy herd, if you think back historically with that dairy herd at about 9 million head, we estimate that you might see about 3 million head. So all the steers would pretty much come to the beef supply chain. But here in the last 5 years or so, we've really seen an uptick in the beef on dairy cross usage. And so what that does is that does create fewer of those full purebred dairies, so the Holstein bulls or steers coming into the supply. And then it also, so it makes for a better beef animal with these beef on dairy crosses. They've really continued to improve to show good conversions, good production, and then also a good finished product with the beef. And it's also added quite a bit of revenue if you think from a dairy producer perspective. So they're able to use sex semen to make sure they can get the replacement heifers they need, and then breed the rest to this beef on dairy. We've noticed less veal slaughter as well. And I think what it's done with the added value to these animals is it's allowed a more efficient calving crop as well. So we would estimate that although mostly it's just a swap from these full dairy to a beef on dairy animal, there's actually been maybe 1 million head increase of fed animals coming from that dairy supply as they have created a more efficient system for getting their replacement heifers. So if you consider that, and then consider fewer replacement heifers again in 24, you can see that, well, with that, so with more animals coming from the dairy side, with not a lot of heifers being kept back, and then you add in the feeder cattle imports from Mexico, we ended up with slaughter up just a bit for this year. So we saw a pretty large decline from 22 to 23, but then this year we expected another decline, but we kind of went against the cyclical pattern by maximizing the dairy herd, by not retaining a lot of heifers, and by bringing in those imports. And so we did see a slight increase here to slaughter as we look back at the finals of 2024. Here next year, we do expect that we've kind of maximized what we're going to get from the dairy herd. And if anything, they might need to make more replacement heifers to build back the dairy herd a little bit. So considering that we've got the same or fewer from there, we're expecting a few more replacement heifers to be kept on the beef side. And then probably not as many feeder cattle imports from Mexico. We've had the challenges at the border here lately. It's been closed since about, since November with the screwworm. And we haven't had any ports open up yet. So that is going to probably take away some of those that were due to come in from Mexico. And then also for the year, we would just estimate that their numbers, or the imports from them is going to be down, as they have seen a little bit better drought conditions as well, which might keep more cattle there. Okay. So yeah, so as you can see, next year we do expect to see this 700,000 head decline, and then for it to continue to get smaller in 26 and likely even 27. So we probably won't see the low for this year in heifer slaughter until we do get into 2026 or 2027. But what we have done here is we've seen a huge increase to these carcass weights. So they continue to run, 10 pounds above year-ago levels in the weekly data. If you look in total last year, we got a record high 27-pound year-over-year increase for this cold carcass weight. A lot of that was increased weights from steers and heifers, so just being fed longer, more days, and then to heavier weights. But also this is considering that we have a different mix to the slaughter. So this cold carcass weight is an average of fed and non-fed slaughter. So having fewer cows and then also heavier steers and heifers and more steers did help create this increase. So as we look on to next year, we are already starting the year with larger weights, but don't expect as big of a year-over-year increase, because that mix in the slaughter has already taken place, and we have put a lot of the increase in already as we consider weights. But we do still expect to see another increase as we look at this year. And then if we look at the last part of the supply equation here, so we've got slaughter, we've got weights, and then we've got the trade. So here this year, we saw a huge increase to imports, up about 20% this year. And then we're expecting to see further gains as we look next year. So we had record large imports this year, about 4.5 billion pounds coming in. And we do expect to see another 5% increase next year. The growth is going to be a little bit more moderate, even as we do have more of a supply decline or production decline here in the US. It's going to just be tougher to continue to see that kind of increase, as global supplies, they're not going to be increasing at this kind of rate still. And so there will be competition there, and then just limited global supply and availability in total. At the same time, we did see exports down just about 1% this year. So we saw a really large decline as we look back last year, about 13%. This year it was more moderate, near steady with last year, but we do expect to see about a 5% decline as we look ahead, just out of the fact that we're going to be producing less beef this next year. And then also prices are going to be high, and that could discourage some of the exports as well. So as we look in total with the small increase to the fed slaughter, the increase to weights, then the increase in imports, and then small decline in exports, we actually came out of this year with a little bit of an increase to the per capita beef supply or beef consumption. So we're not as high as what we were in 2022, but still up a little bit from a year ago. But as we do look on ahead with those declines in production and the limited growth that we'll see to the imports, we do expect to start to see this per capita supplies move lower next year and then on forward as we do get deeper into the cattle cycle. So now switching gears again to go into kind of the economy situation and demand. Here we've continued to see strong interest rates as we think this year. We did see a little bit of a decline, and they're not set to go higher as we think ahead, but they're still at historically elevated levels here, up around 8%. Inflation has come down, but prices are still increasing year over year, and the consumer is still feeling some of the squeeze that we saw from those extremely high inflation rates that we saw a couple of years back. So the economy is in a better situation than what we saw a little bit even just a year ago, but the consumer is still fairly squeezed as we think about these factors. Now, what has continued to be good is the job market. So you can see unemployment has stayed relatively low. The most recent number coming in around 4.1%, down just a bit. And so that's really positive for beef demand. People are having jobs, and so incomes are still decent, but at the same time, if anything, the job market's almost too good as far as there's not enough people, and that can make it hard for labor and restaurants. But if we do think about, we don't have the charts in here this time, but if we think about food service, they've seen improvements in that situation as well, showing more positive outlooks as we think ahead with more consumer traffic and same-store sales. So with those numbers up, that is also a positive sign, but labor does continue to be a challenge throughout all industries, really. But as we think about demand, it really did exceed our expectations this year. So we did expect to see these higher prices, but we saw these higher prices with a larger supply. So with that per capita consumption higher, we still saw prices higher. So that does show stronger demand than a year ago. Not quite to the record levels that we saw coming out of COVID, but extremely strong demand as we look back historically. And retail prices have continued to move higher as well. I chose to put this retail price in here. You can see that we're going to average 2024 at right at $8 a pound for the all fresh retail beef price. As we look on to 2025, we do expect that to continue higher to help ration the tighter supplies. Measurably with the tighter supplies, this price increase probably will still show weaker demand. But if you look back historically, still expecting historically strong demand here in 2025 as well. So yeah, beef is really held together as you think from a demand standpoint, because not only did we bring in more beef this last year, but prices continued higher, and expect that we're going to continue to see higher prices as we look this next year. And Holden will get into it a lot more, so this is a retail, but he'll get into the wholesale and the fed cattle, but it would look pretty similar here as far as strong demand, and then of course an increase in price continuing. if we look at so again, Holden will get into the fed cattle prices, but if we think about what's driving this strength in demand here for the beef, beef has outperformed compared to chicken, compared to pork, compared to most goods that you'll get at the grocery store. That's really been led by demand for this higher quality beef, so choice and prime. And that's been passed back to the wholesalers, so you can see that in the box beef prices. But then we're also seeing that as we look at these grid premiums. So you can see that we've continued to see these strong premiums here for cattle that are grading over 80% choice. So this is just money on top of this is a premium on top of what the fed cattle price is for these cattle that are grading a high percentage of choice or prime. And then also at the same time, there's even a discount if they're grading more select or under choice really. So the growth has all been in those higher quality beef, and we expect that to continue to be the trend as we do move forward. And the last part here that I'm going to talk about is our fed slaughter supplies, and then compared to this capacity, the packing capacity. So here these blue bars are showing this packing capacity. You can see here in this last cycle, we did see that decline as several plants closed down here between 2013 and 2015. So we saw the capacity get pretty tight there. And at the same time, we saw this fed slaughter supplies increase pretty rapidly. So what that created was just a situation where we had a lot more cattle than what we had hooks. And then through COVID, we had quite a bit of disruptions, which limited the packing capacity further. But here, as we think about this year and then on forward, we've actually, if anything, added capacity. And at the same time, we are seeing that smaller supply of cattle available. So 2023, you can see that we finally got more into balance there, where supplies were in line with capacity. Here now we are moving to where supplies are quite a bit below capacity. So this means packers aren't having to run on Saturdays. When you did see that slaughter running above capacity, that was some Saturday kills. But here as we move forward, demand from the packers is going to be strong, as we do have more capacity than what we have cattle available. Now this does open up risk, of course, to them either shortening their kill weeks, so shortening their hours and not processing as many, or potentially we could see what happened in the last cycle where we did see plants closing down. And so if that were to happen, that could flip things. But as we look into this year, we do expect to see a favorable situation for the cattle feeder and cattle producers as we think about the packing capacity compared to the available supplies. And with that, I'm going to pass it over to Holden Ramey here, and he's going to tell you what you all really want to know with the price outlook for 2025.
Well, thank you, Mary. As she said, I'll be kind of taking y'all through a price outlook here for 2025, and also having a little bit more in-depth conversation as it pertains to calf prices, as well as female and bred female prices as we look on down the road. As Mary said, my name's Holden Ramey. I'm one of the analysts on staff here at CattleFax. And with that, Mary, let's go ahead and roll that next slide and let's get into it. So starting here with the composite cutout value, I like to start the price conversation kind of big picture here. And obviously y'all can see the cutout does tend to increase over time following, kind of inflation and all that. But it does ebb and flow with the beef or the cattle price cycle, as Mary discussed in her section. This year in 2024, cutout average right there around 305. As we look forward to next year, or this coming year, I guess I should say, still adjusting to that, we're expecting the average to be around 317. Obviously, with the tighter per capita supply that Mary discussed, the market's going to have to continue to move higher in order to ration those tighter supplies. So ultimately, that's the reason we have that increase penciled in here for 2025. Now, certainly, there's things we're going to have to watch here on the cutout from a price standpoint. Obviously, if we get into more of a more rapid heifer expansion, or demand continues to hang here at record levels, this forecast for the cutout may be a touch conservative. But at the same time, if we get into any economic troubles, or if the consumer feels even more squeezed as we go forward, that would obviously pressure this a little bit. So just things we'll have to watch going forward. Now, as we look to leverage here, and the way we like to look at leverage here at CattleFax is taking that fed cattle price as a percent of that composite beef cutout price. And you can see the asterisk there on the bottom left-hand side of the screen. That's excluding that drop credit. But basically, this is just showing how big a piece of the pie the cattle feeder is getting. And you can see here back in 2021, when Mary was just talking about how we got into a situation where we had quite a bit more cattle than we had hook space for. The packer had all the leverage. They were getting the bigger piece of the pie. This leverage ratio fell down to 40%. Well, you can see here, again, as she discussed, we've tightened up the cattle supply, to a point where there's actually more hooks than cattle. The cattle feeder has been able to gain back leverage here over the past 3 years by leaps and bounds. Here in 2024, average right there about 57.3. And as we look towards 2025, we're looking at a 58% leverage level. And that's certainly important. Means more dollars flowing back from the packer to the cattle feeder, and ultimately more dollars from the cattle feeder back to the cow, calf, and stocker operator. So continuing on here with the fed cattle price outlook, starting with just a brief seasonal conversation here. Fed cattle prices there in the green line tend to follow a typical pattern, rallying to a high sometime there in the spring when inventories are tight and you're just about to get into that spring grilling demand. Then you typically soften back through the summer, particularly late summer. That tends to be when you get into a few more fed cattle supplies, and at the same time grilling slows as the heat of the summer comes on. And then you rally back into the fall as you get that big holiday rib push. That's the main driver there. Well, you can see the last couple of years have been seasonal-ish. Obviously, 2023, that was kind of the big push in the cycle. We pushed all the way through the first half of the year, making kind of a summer high there. 2024, kind of the same, a little bit later high there, coming in kind of that June, July time frame, but just more range bound at these higher levels. And for 2025, we're kind of expecting more of the same. Probably a later high, and the reason for that is partly in because the suspended fresh beef programs have delayed that seasonal high. At the same time, with adding days on feed to these cattle, it becomes really hard to get a calf fed ready by that early summer time frame. So you do kind of get a little bit more of a gap in supply. So ultimately, the 2025 outlook here on the fed cattle slide is averaging there around 195. That's up from the 186 average in 2024, and trading that full range here from 180 to 210. You can see we've started the year here off pretty stout, setting new record highs in the cash market here, trading on top of $2. Again, with the range that we've outlined, we do expect to exceed that sometime later in the year. Rolling forward here to the feeder cattle index. Again, we'll start with just a brief seasonal conversation. That gray dashed line illustrates that. Again, typically you soften back in the late winter, early spring time frame. That's when a lot of those feeders coming off winter grazing come to town and come to market. Supplies are typically picking up. At the same time, you got feed yards that are dealing with winter pen conditions, so maybe demand's a little bit stifled there. Then as you go through the summer and early fall, those supplies really tighten back up as a lot of cattle are out on grass. At the same time, feed yard demand picks up in order to refill those pens. And then through the end of the year, you typically get a little bit more softening in prices. Again, just got those cattle coming off summer grazing and heading to market. Again, last couple of years have had seasonal time periods. Again, that big push in 2023, that's probably likely the big push in this cattle cycle. 2024 certainly was that kind of year where you were just more range bound at these higher levels. But again, not incredibly seasonal, especially as you look here towards November, December, and then the first couple of data points to start 2025, we've actually been increasing instead of following that seasonal pattern lower. Which the reasons for this include, as Mary kind of alluded to earlier, the suspension of Mexican feeder cattle imports certainly helped drive domestic prices here higher. At the same time, do think we saw pretty solid feeder cattle demand here through the winter, late fall and early winter time frame, as feed yards were into some profitable levels. And ultimately we're chasing back feeder cattle in order to fill back some pens here. As we look on down the road here in the short term, I guess we kind of expect still maybe there's some risk on the horizon for the feeder cattle index, especially as we go here through the late winter and early spring. Still have some decent sized feeder cattle runs ahead of us, especially here lately. Does seem like there's some auction barns starting to pick up. At the same time, as Mary talked about early on in tonight's presentation, corn prices, certainly where they've rallied, cost of gain becomes a factor as well. And at the same time, another headwind would be the southern border. Does sound like should be getting a reopening here in the not so distant future. But at the same time, that situation remains very fluid, so we'll have to monitor that fairly closely. So the outlook for 2025 here, averaging there around 260, up from the 248 in 2024. Trading the full range there, probably 250 to the mid 280s. Again, you can see we're pretty close to the upper end of the range today. First level support would be right there at the average at 260. That'd be kind of our first target level if on any pullbacks. Calves, again, talking a little bit of the seasonal pattern here. That gray dashed line shows it pretty well. Typically, your calf high is during spring calving when the calf supply is at its lows. Then you kind of moderate back through the summer into that fall time frame. That's typically when a lot of cattle are coming off summer grass, and you do see quite a bit of calves coming to town, so the supply increases. So that ultimately pressures those prices back a little bit. Again, 2023, you rallied throughout much of the first 3 quarters of the year. 2024, again, a little bit more range bound, although relative to both the fed and feeder cattle markets, this was probably a bit more seasonal than those two. So going forward here into 2025, expecting that very similar seasonal pattern. The tighter beef cow numbers and the subsequent calf crops will keep prices pretty well supported, averaging there around 335, trading that full range from 310 to 360. There we go. So continuing on with our calf conversation here, this chart illustrates the percent change from the second half low to the next year's first half high. And you can see here the 20-year average rally is about 23%. The low that we're referencing here for the 24-25 year that was around 286. So from that point last fall, we've already rallied about 17 to 18%. So we've already we've already rallied a bulk of what history tells us we should. Now, certainly, there's still some room to the upside. The full rally gets the calf market back closer to 352. And you can see compared to the previous low in that calf supply back there in 13 and 14, obviously things can get pretty stout. Now, I'm not suggesting that we're going to get a 55% rally in the calf market this week, but something above average is certainly possible just due to how tight the supply has gotten. Rolling forward there, Mary, on that next slide, we're kind of starting to switch gears a little bit here. Just comparing bred female prices against U.S. average 550 steer calf price. And over time, you can see that they're pretty highly correlated. They move pretty much in step with one another, which makes sense. If you consider producer has a pretty solid year from a calf standpoint, as Mary said, profitability is one of those factors that drive expansion. Obviously, if calf prices are moving higher, producers might be more motivated to expand, and ultimately that keeps bred cow prices moving higher. Now, just a couple things wanted to point out here. From 2016 to 2022, you can see the gap between those two lines certainly widened relative to how it had been in history. A lot of that was due to just the low interest rate environment we were operating in. And then you see it start to collapse there from 2022 on, a direct correlation of higher inflation as well as higher interest rates. As we look towards 2025, obviously, with maybe a little of expansion on the horizon, we are expecting that gap to widen out and expecting bred cow prices to continue higher. You can see our forecast there in the upper left-hand corner, averaging 3,100 or 31 bucks a head. That's up from 2,700 bucks a head in 2024. And just looking at it across all classes of replacement females, again, you have the cows and heifers there from $2,800 to $3,000 a head. Pairs up there towards $3,600. Our next forecast for the next couple of years is for those to ultimately continue higher, but certainly at a flatter pace than what they have been previously. Now, certainly, weather will continue to be a driving factor in this. If we do happen to get into a wetter pattern, which certainly is in the forecast that Mary and ultimately Matt laid out for us there earlier in the presentation, these forecasts would likely be a bit conservative, but at the same time, we get into a little bit of a drier pattern. These may be a little rich at the same time. Now, certainly, we're not expecting the blow off top that we saw during that last rapid expansion. Instead, prices will likely flatten out here and trade at these higher levels for a longer period of time. Just doing a little balance sheet math here, excuse me, a little simulation based off that bred heifer purchase price there in 2024, 3,000 bucks. Cost us $622 to carry her to her 2025 calf. We get $1,600 for the calf. You can see here, we're still 2,000 bucks in the red. Cost us another 700 or dang near 800 bucks to get her to her 2026 calf. We get $1,600 for that calf. We're still in the red. And you can see the same math as we go forward here. Obviously, there in 27 and 28, we have a little bit softer calf values penciled in there. Again, just due to the fact that we do expect to be getting into a few more calves out during that time frame. So do expect that prices may start to soften back. But again, that's just kind of a rough estimate. You can see there, we're still in the red at the end of year 3. But by the time we get her to her 4th calf, we are finally in the black there by about 385 bucks. Now, it is important to note this is just a cash-to-cash simulation. It doesn't include interest, depreciation, returns to management, salvage value, anything like that. This doesn't include any of that. So obviously, if you were to include those things, that would change this math some. Looking towards the right-hand side of the chart, as Mary circled up there, the long-term average is about 4.5 calves to pay for the female. As we did the math on the left-hand side of that slide, we're a tick below that today. Obviously, we're not nearly as high as we were back during those blow-off highs of 2015 when the female market rallied so high. Took as many as 9 calves to pay for a female, but we are up from the cycle lows there at 2 calves. You can see going forward, our estimate is that with higher female prices, it will continue to take a few more calves to pay for them, getting up there towards 5 calves in 2027. So this is just kind of a continuation of the math we walked through on the previous slide. Basically, it's the bred female value after X amount of calves. You can see 4 calves there in the first column, 5 calves, and 6 calves. And then you kind of got to pick a steer calf price there on the left-hand side of the column. Now, I know certainly we're above the 310 and 320 levels today, but at the same time, you got to be a little bit more forward-looking with this. 6, 7, 8 years down the road, what do you expect us to average here over the really long term? I kind of thought, 310, 320 is kind of my best guesstimate for today. So you can see there, after 4 calves, females made $3,200 to $3,400. Well, if we spent $3,000 on her, we are a bit in the green. And again, that just further drives home that point that it takes a little more than 3 and a little less than 4 calves for a female to pay for herself. Well, as we go on down across those rows there, you can see that 5 calves, 39 to 4,200. But if we get out here and we're spending $5,000 on a bred heifer, you can see it'll take more than 6 calves in order for that female to pay for herself at steer prices that are averaging 310 to 320. So again, just kind of some perspective provided here, and just trying to be forward-looking in our thinking. Shifting gears away from our replacement female conversation onto our cull cow values, this is actually one of the better seasonal patterns amongst the classes of cattle, and I say that I probably mean more reliable. That gray dashed line, you typically rally to a high there in the spring and summer time frame. Again, this is when most cattle are out to pasture. At the same time, you're kind of into peak grilling demand and peak trim demand. Then out there in the fall time frame, the cull cow prices typically drop off fairly sharply. Again, cattle coming off grass, producers culling opens, producers culling old cows, a few more cows coming to town. At the same time, that's not known to be a real strong grilling time of year. Our outlook for this year looks not too different from last year, just at a higher level, averaging there around 135. That's up from the 126 of last year. With the full range, 120 to 150, you can see we're trading probably towards the low end of the range here today. Likely we'll continue to push higher, especially as that spring grilling demand starts to kick in over the next couple of months. As I said, the 90s lean trim price drives a lot of the utility cow values here. And certainly as we look at 2024, lean trim got extremely stout, and that was primarily driven as consumers substituted within the product. Maybe they were buying a little bit more ground beef and a few less steaks just as they felt the squeeze. So ultimately, excuse me, that was what supported lean beef values in 2024. And in 2025, we're expecting a very similar shape to the market, and likely getting up there towards $400 a hundredweight, or $4 a pound out there in that May, June, July timeframe, during that peak grilling timeframe. So this chart's just kind of a recap of everything we've kind of covered here in previous slides. You can see the big picture here is that the big up in this cycle is probably in the rear view mirror. We've seen sharp increases in each of these markets already. Now, certainly, there still is some room to the top side as we look out here towards 25 and 26. But again, the big push that we saw there in 2022 and 2023, or 2023 in particular, I should say, that was likely the big push of the cycle. So this is a slide we CattleFax like to round out a lot of our presentations with. To me, it just provides some big picture perspective. Again, this is total industry profitability and how each of the four sectors had to split it up over the years. You can see basically from 1980 to the late 90s, we were averaging about $32 a head. Pretty small sum for each of the four sectors to divvy up. And that certainly wasn't a sustainable business model for any of the segments. Then as you look towards 2000 to 2012, you certainly began to saw that demand growth at work. We were averaging around $170 a head, with most of that money flowing back to both the cow-calf and the stocker operator. Then from 2014 on, we really continued to see expanded demand growth. We were averaging upwards of $570 a head. Again, throughout that kind of 19, 20, 21 timeframe, you can again see what Mary was talking about back there, just how we got ourselves into the trick where, you know, there was just more heads than there was space in a packing plant for. So that's when the packer gained all the margin back. But you can see here, as we've tightened that cattle supply up, and as you know, we're actually expanding packing capacity some as well. We're in the situation now where we have more hooks than we do cattle. Packer margin's been taken back close to a break even, and you can see that margin flowing back again back to the cow, calf, and stocker operators. So again, just kind of a big picture graph to represent profitability growth over time, as well as how each segment kind of ebbs and flows in margin through time as well, based off market circumstances. So with that, a couple upcoming events we wanted to highlight here as we close out. CattleFax survey, I believe, has been sent out. If it hasn't, it will be sent out here very shortly. As many of you know, it's an important project of ours, so we certainly gain many valuable insights out of that exercise. So encourage all of y'all to return those as soon as possible. We will be giving our global protein and grain outlook at the NCBA convention, as we do every year. That'll be on February 6th in 2025 in San Antonio, Texas. Look forward to seeing all of you down there. The next Trends in Cow-Calf webinar will be on May 21st, so be sure to mark that on your calendars. And with that, Mary, I am not seeing any questions unless you are.
Yeah, I don't either. The cow-calf survey did go out. Okay. And so if you didn't get that in your email, you can also go to our website, CattleFax.com. There's the About tab, and then you can get to that. For filling it out, whether you're a member or not, you'll get the results from that at the end. So we encourage you to fill that out, because the more data we get, the better that is. So just wanted to throw that out there. But yeah, I still don't see any questions, Holden.
Well, if you scroll down to the next slide, if any of y'all do have any questions as we go forward through the next coming days, don't hesitate to either email Mary or myself. You see our emails posted there on this slide. And just one other quick note, there will be a recording of this webinar accessible for the next month at our website, CattleFax.com. So again, if you have any questions, don't hesitate to reach out to either of us. So we're happy to answer anything you might have. And with that, hope you all have a great rest of your evening, and we look forward to seeing y'all soon.
Yeah, thanks everyone.